US markets were down last night, largely on big tech sell-off, as well as a broader markets sell-off. What we are seeing is weakness in the US markets, but that is leading to some flows coming back to emerging markets. And India saw a good surge in its markets yesterday. It was on the back of FPI selling, turning net buyers after a couple of months and nearly 6 months of sustained selling. We saw a big buy number from the FPIs. What India is now seeing, Gunjan, is reasonable valuations. We are seeing a strong fiscal with good government spending coming in, boosting the economy. We are seeing an economy which has probably bottomed out in September and corporate earnings which are near a bottom, if not bottomed out in December itself. And we are seeing monetary easing with RBI cutting rates. Second, RBI easing the credit conditions it had put, so macro-prudential easing, and RBI injecting liquidity. All that has set up Indian markets for a good recovery. However, very key support levels remain, and the markets have to stay above those to really make this a sustained recovery. That is, in sum, what's happening in the markets. Not yet. Cautiously, they are getting up. Yesterday was more short covering, so the bears are getting caught out and are being told to retreat. The bulls will really start once, you see some key levels like 23,200 being taken and being sustained at. Otherwise, we have seen this 3 times where around these levels, the market has turned in the last 6 months and then it goes back. So not sustained. Yes, we are expecting a pause by the Fed today. The big risk is that the Fed will be out with its SEP, the dot plot. And we are expecting that they will point to one rate cut this year. They will point to sustained inflation and a little lower growth. And fourth, they will say we remain data dependent because we are not able to yet gauge what the Trump actions will be on the ground. So we are going to be data driven and meeting to meeting. However, the markets are over optimistic. Bond markets, Gunjan, are seeing 3 rate cuts this year. So the Fed futures are discounting June rate cut starting and 2 more rate cuts after that. While the Fed today, there's a big probability that they will show 1 rate cut. So the Fed might come out more hawkish than the market is anticipating. That's why yesterday we saw the US market falling quite sharply. The second big thing, what could help markets and will be seen as dovish on the part of Chairman Powell would be if he says the balance has moved towards growth being under risk rather than inflation being a bigger risk. If he makes that statement, then markets are going to surge globally. So we are waiting for that statement. If he says that our concern is more growth rather than inflation, if he says that statement, it will be very positive. We don't think he'll say that. He'll probably say it's equally balanced between inflation and growth. No, we'll have to wait and watch. India is expecting that we get off lightly. So any broad-based tariffs on India, especially on our big exports into the US, like gems, jewelry, or engineering goods, electronics, pharma, all these are under threat. So, and our tariffs on US goods are much higher than what US is levying. So, overall, if a 25% tariff comes, the impact on the Indian GDP could be as high as 0.5%. So we are not that big for the US. We are 11th biggest trade deficit country. And we can always buy more military goods and oil and gas from the US, which the Indians are, which the Indian government has been trying. We have been trying for that. Hopefully, we will get some rebate from the US, but we have been hit with the 25% tariffs on steel and aluminium. So our smaller steel manufacturers are already hurting with that, though our trade with the US on steel, aluminium was not very big. But overall, $80 billion plus of goods are at risk of being tariffed. So April 2nd remains a very big event risk. No, no, it's very much possible. We are just at handshake distance to it. Overall, as I said, what is moving our markets, valuations have become more reasonable, fiscal is catching up, monetary has eased out, and economy and corporate earnings are recovering. So overall, we stay a beacon of a major economy which is growing in double digits in nominal terms, and corporate earnings growing at 12 to 14% for the next 3 years. So we make a good case for incremental foreign money to come in. Even if the foreign outflows stop and we stay positive on a daily basis, just minor selling happens. Even then, the domestic flows will take this market higher. So it's a question of when. It's not a question of if. I think today you could see some Fed-based scare in the market. And tomorrow, once that gets digested, the markets will recalibrate for the next couple of months. April 9th, we are expecting RBI to cut rates. So that will be a boost to the markets, and positioning will start happening accordingly.